Hi, gang. I am back, and I've been gone for 6 months. I just want you to know that there was a gap in the recordings for 6 months because of a personal situation. Some of you know that my mascot, Labrador Retriever Maxie, almost died. And it took about 5 months to totally bring him back to health, and I'm good and I'm ready to go. And this is the relaunch of my Price and Time channel. So let's get started. Today we're going to talk about the introduction to bull and bear traps and emotional inducements using price and time. Okay, so this teaching is going to be a little bit different than some of the other teachings that you've seen about inducements in the SMC world plus bull and bear traps, because I am of the belief, after watching dozens of SMZ videos, some of which are very good, and some of which, in my opinion, this is my opinion, when it comes to inducements, it's very confusing, and I believe that it creates more questions than answers. So I'm just going to come out and say right here that we're going to keep this simple, and I'm going to say an inducement is an emotional experience, just like FOMO is, fear of missing out. And I'm going to say that inducements are emotional, that the trader does, whether he does it through his own instincts, because we all bring our own human urges to the party, the things that have made us successful in other areas of life. Unfortunately, that doesn't work in trading. And so the inducement is designed to get you to go the wrong way at the wrong time so they can take your position basically by taking your stop loss when it goes the other way and the move ends up going without you. And I'm here to teach you how to make sure that that doesn't happen to you. Now, one of the biggest traps, we're going to start with the trend line trap. Now, this is the trend line game. We have start of a trend, retest, holds, forms the trend line. Some traders who either, for whatever reason, missed this, didn't know about it, got here up here, are waiting for that pullback at the second touch of the line. Now, here's the problem. It goes through that line with a very intimidating wide range bar. It creates two problems, actually. One for the people who are going to go long, and I coach traders, and a lot of them have told me that after they would see something like this, they're too intimidated to actually go long and go against this bar. On the other hand, there is an inducement to get this price down here, and you know that it has to be, that what else would it be if it turns right back up on the very next bar? I believe that that's a game that's played. Okay? So it's intimidation and it's emotional, but it's designed to get in your way. So what's the solution to that? Well, first of all, here's our disclaimer that we have to say. Trading isn't for everybody. It may or may not be for you. There's a lot of risk involved. And do all your due diligence and homework and read everything in here. And viewing or purchasing of this content constitutes you agree to this notice and exempts author, his agents, and distributors from any liability or litigation. You guys know that. I have to put that here. Anyway, so let's go on to the solution. This is the exact same chart on a 4-minute, where the other one was on a 1-minute. So how do you solve that problem? On the 4-minute, we're here, and it looks totally different, doesn't it? Now, what is the solution? Price and time is the solution, because when we look at the low at 462 and we look at this pivot in question as 696, it's 34. 62 to 96. Yes, we know it's 234 points, but we're interested in the 34 aspect of it. Why? Because on the 4-minute chart, which is what I use for this specific reason, is that we're looking at 35 degrees on an intraday chart, which is the 4-minute chart, and it's 34 points. So price and time square out almost perfectly here. We like to use a margin of error of plus or minus up to 2. So this is right in the margin. And look where it stops going down, right at the moving average on the 4-minute chart as opposed to the 1-minute chart. And that makes more sense, doesn't it? Now, this is a pretty standard type of bear trap that you've seen. The last leg, the trap is the last leg. Now, these are either sellers who panicked or bears who got in too late or a combination of both. Whatever the case, they get flushed out. The market rally, I guess they get flushed out right here when this fails to go down. And it's not a coincidence. There's no coincidences in the market where this red bar is right exactly on the top end of the real body candle to the last bearish bar. Later on, the retest comes right back down to the line. It's a little over, but it's like right there. Now, why does this work for us? Because in terms of time, we have 41 bars on a 15-minute chart, and our retracement is a 70% retracement, and the inverse of that is 142. In my teachings, in my training program, and on other videos, we've discussed the fact that almost any number can be a retracement. It doesn't have to be 38, 50, 61, or 78% like the Fibonacci people have taught you all the way back to Gartley. That's just part of the picture. See, everybody knows that you take the smaller leg into the bigger leg, but what about the relationship of the bigger leg to the smaller leg? The bigger leg in this case is 1.42 times the size of the smaller leg. That's our price relationship. 41 bars on the time relationship within the margin of error, and you could see, well, there's no sellers down here. Price and time lines up perfectly. This is exactly what's driving the markets, and away we go. That's your edge. Everything else that I'm showing you is what to do with your edge and how to deal with these situations at the right price and the right time so you can have the best possible risk-reward ratio on the entire pattern. Here's another situation. Last bar trapped. Now this is just a replication of time. Sometimes that's going to work too, although you do have a price and time relationship at the low. The low is 684, 4684. These are the Dow futures. And from here to here, which is 836 to 751, is actually 85, 86 points, right? 836, it's 85 points. So 85 replicates with 84. That's where it goes. You can have the confidence to know that you're doing the right thing because of the replication when everything lines up this way. And that's a pretty good looking setup. And this is how it looks on a larger time frame. It's pretty self-explanatory when you understand what the market's doing and when you know what you're doing. This works for bull traps as well. Here's your trap. Here's your line. Lines up just right. Now here, what I'm not showing you is the down leg And this leg is a 71% retracement of the leg that I'm not showing you because it doesn't apply to this particular example. Okay, trust me, it's 71%. Now, replication means that on this line, well, first of all, you have 72 points down, right? So you got a lot of repeating of the same numbers. So the bigger leg in relation to the smaller leg is 1.71 times. That everything lines up perfectly. And what happens? There's a lot of price and time relationships in here that probably applies to my teaching on quantum physics. But for the example here for traps, you want to stay in this long enough to get paid. And you really don't know where it's going to end. And you don't want to give a bar like this back. And it's a process to catch more and more of this. I caught a good portion of it. But sometimes you leave a little bit on the table because you don't want to give a bar like that back. Thing is, what you want to do is get into it early so you can participate in the larger bar, so at least you can get paid. Now we went from 1 minute to 4 minutes to 15 minutes to the daily chart. And this is a daily chart of Morgan Stanley. And in other teaching, I've taught you on the Gann calendar, this particular day, which is the bull trap, is the 114 DG vibrational day of the year. This retest is the 157.5 DG. So the difference being 43.5 is important because it matches the fact that the bigger leg in the relation to the smaller leg is 1.41 times the size. Now it's 2.5, 2.5 margin of error. It's close enough. But here's the thing. The trap forms here. You may or may not be able to get into it here. And maybe you only found out about this move here. So what do? You have to develop the patience and discipline and confidence to be not confident in yourself, but be confident in the process because this works. And what we're looking at, like the other charts that I showed you, the most ideal situation is that it fails right at the line, which shows you that for right now, there's no more buyers, so you can get a nice trading leg down. And this ends up being a pretty good swing trade. It stops going down right at a little bear trap. What do you know about that? And the line's perfect. It's close to the 200-day moving average. So you really have traps on this side and traps on this side. And sometimes when you have trading ranges and you have the traps on both sides, that'll be a consolidation. It'll be a trading range type market. And so this is an advanced indication that that's what could be happening. Now back to our trend line inducement game. This is on a 180 chart, and this is Netflix. Okay, so here's the thing. You're waiting patiently for this to come to the line and give you another short. So if it goes past the line, do you go long? Well, since 90% of traders out there lose money or don't make money, yeah, there's going to be a lot of people making this mistake. Now, you who have been looking for it to go short here, are you going to be intimidated and still go short despite this big bar? Well, it's going to depend on the readings, actually. The readings are going to bail you out all the time. And in this case, you have a high-to-high difference in price of $3.27. And in terms of nonlinear math, that's what we're doing, thinking out of the box. That's how the market really works, gang. is either a 32 or a 27 would match. In this case, it's 32 hours. And so that's where the downtrend picks up, and it gives you another good swing trade. The idea that I want to get across to you in this video is that while this is like a short teaching and an introduction to this whole thing, there's a whole science involved in traps, emotional inducements, and the solution fix for you, which is mostly price and time relationships. Because Gann taught us 100 years ago, when price and time square out, the pattern changes direction. So that is the key driver to all markets. But you have to know how to do it in the right time and place. Now this is zebra, which is another situation. Breaks the trend line. It's already confirmed over here. Breaks the moving average. Will you be induced? And the bigger moving average too. By the way, that red line is a 200 period moving average. Are you going to go short here? Or are you going to be intimidated to go long and stand aside? See, that's the question. And so what's the answer? The answer is 32 bars from low to low. And why is that important? Because the range is $17.34, so it's a margin of error of 2, and the middle pivot is 325.31. And elsewhere I've taught you that the numbers to the right of the decimal point are not only the placeholder, but it's the time holder as well. And these numbers, these sense holders, are not random. And there's no coincidences in the market. And so when you understand how to use the numbers to the right of the decimal point, this whole thing starts to make sense. Now, this isn't the greatest move up because it melts up, but still, that's what you're looking for. And here's actually the 32 bars, because this one is a smaller time frame. That's not 32. Okay, this one's 32. Okay, so let's move on, because that's the 31 is the tell. Okay, now this is a nonlinear situation. And the problem is that going back to the days of Gartley, you Fibonacci and Elliott people have learned how to judge patterns from low to high, high to low, high to high, and low to low. But the market thinks out of the box. You know that the market is chaos theory, nonlinear math, quantum physics, all that good stuff. What does that really mean? And how do you use it? The point is very simple. You have a pullback of 369 points, and we take the two legs going down in the same direction, and when we measure it, it comes out to 68, 69 bars. So the time, which is not low to high or high to low, you could see this is pretty much out of the box, lines up perfectly with the number of points. And so I challenge any one of you to come to me and tell me why it's different. What something else? I've looked at these kind of patterns, and with this precision, you have to say to yourself, if this was random or if something else was going on, what are the odds that the move from here to here in time and the move from here to here in price would match 69? I mean, it would have to be millions to one against it. You probably have better odds of winning the Powerball. So this is what it has to be. Okay, and here's a situation where we have our trap right here. Here's the line. Here's the trap, and it goes down and retest. The question that you may be able to get into it over here, but usually the retest is the area that leads to the best move. The first move is usually like a first wave, but the second retest, when it fails, usually leads to the bigger moves. Now, in this case, I just wanted to show you the setup, and the setup you can best see when we scale down from a 4 minute to a 1 minute. The setup, as you could see, 34 minutes after the hour to 29 minutes after the next hour, that's 55 minutes, right? The move from here to here is 255 points. It all lines up right here, and it even gives you a little bonus tell. The intermediate level high in the middle of all this is at 55 minutes after the hour. Tell me this is a coincidence. It's not. So the question is, in all these videos, they're telling you you have to have discipline, you have to have patience, you have to this, you have to that. But do you have a methodology? Do you have a game plan? Do you have an edge that allows you to sit back and wait patiently for the situation to line up, and when it lines up, you know what it is? That's what you're looking at right here, gang. And this is a 1 minute E-mini, E-micro. It's a fast market. How do you master that? I think the only way to do it is like this. And knowing price, and I mean, you could do traps, but you might get in at the wrong pivot that's not lining up correctly. What the complete way of taking advantage of trapdoors slamming shut is knowing price and time relationships. You can't convince me otherwise. Okay, and so here's the major trapdoor slamming shut. That's what it looks like. Now here's FDX, another one of these inducements, emotional inducement. Okay? We see this a lot. And I'm here to tell you that and I think you already know this, and this one even bounces off the 200-day moving average. Imagine that. And it takes out the trend line. So how many people went long here? Well, it's not a big volume, but there were people that went long. And at the very least, there are shorts that covered. Whatever the case, it's not the right play. And that's not me telling you this. That's the market telling you this. The market is the only thing that counts. And the bottom line is, I've seen this play. I've seen this movie over and over and over to know that this is a thing. Is that what the kids say these days? Okay. So, what's the cure? Price and time, right? This move is a 35% retracement of the drop at the same time that's 35 days off the high. And that gives you a nice swing trade to a fresh new low, which takes out the trend line. I mean, it takes out the moving average. This is a play that repeats over and over and over. Once you understand that, you may adjust your philosophy to not pick tops or bottoms and try to wait for a good secondary low, which is stuff that I teach in the video on replication and in that manual. And you don't go long until you get a good secondary low, and that helps, in the very least, that makes sure that you don't get induced to go long emotionally just because it looks good. Okay, but this is a short teaching. All this stuff is we have this for you. And here's the last chart. This is the same play. I mean, it's the same play, okay? And by the time it gets here, a lot more people will think that the bottom is in. This is pretty much what the SMC people are showing you as an inducement, is a leg this size. So they take it way beyond the trend line, and they even take it above the moving average. And then look what it does. So how do you know to be out of this thing? Because you could have rode this long. I mean, this is a 15-minute chart. If you're an intraday trader, this really isn't an inducement anymore. But if you're an hourly or a bigger trader, yeah, you're going to end up losing money. So how do you fix that? Very simple. From the high to here is 68 bars, and the price is 59,168. Perfect match, and it sells off. Okay? So I hope that I've helped you introduce you to how you can take advantage of trapdoors slamming shut using price and time, and I've introduced you to an inducement that you don't even know that you're being induced. And I know traders that they keep getting they do well for a period of time, and then they get themselves into an emotional situation where they end up on the wrong side of the trade, the wrong place, the wrong time, and they give back the whole day's profits or a whole week's profits, and they don't get to where they want to get to because they don't understand that the whole thing is a game that they need to be aware of. And the game is to induce you to do the wrong thing at the wrong time based on your emotions. And the stock market happens to be a place where you're not supposed to go with your feelings. You're supposed to go with what the market is telling you. And you need to be sharp enough to be able to understand that when price and time is lining up, even if you're long, it's time to get up. I think what they call it in the movie, the 21 movie, where the MIT blackjack team took Vegas for millions, he said that you always have to account for unexplained variation. And what is unexplained variation? That's a statistical term that is what may be coming against you that you don't know that you've got to find out about. Now, the complete teaching on this is in a PDF manual, $37 through PayPal. Send funds to my email, lucaswaveman@gmail.com, or request an invoice or any other questions that you might have. And I have a Substack. Also, we're working on a new website right now. Finally, I have a YouTube training special only for people who watch this video. You must mention this video to get the discount. I'll give you the discount to come into the training program because you watched the video. The training program is currently priced at $987, and usually when I do a discount on there, it's like $700, something like that. It includes a personalized Skype call with me every other week for 12 months, unlimited email support. There's over 30 manuals. It's a complete NFL-sized playbook with intraday swing position trading, investing, stock, futures, commodities, Forex, Gann calendar, everything you see on all the other videos, the whole 9 yards. Okay, so that's pretty much it for now. We're going to have more videos really soon. And thanks for coming.